Hey everybody, this is OG John here. And before you celebrate the green on your screen, before you think the worst is over, I need you to rewind the tape to last Friday at 3 p.m. Eastern Time. Do you remember the feeling? Gold plummeted 20% in 48 hours. Silver saw months of gains erased in a single vertical red line. The financial media called it a correction. They called it profit-taking. They're lying to you. What you witnessed wasn't a market correction. It was a liquidity flush, a calculated mechanical execution designed to strip assets from weak hands before a major policy shift. And while you were watching the crash in horror, a $10 billion signature was being drawn on a document in Washington, a document that changes everything. Stay with me, because what I'm about to show you proves the US government just admitted they're out of silver, out of options, and out of time. The screens are green today. The panic seems to have subsided. If you look at the charts, you might think the market has stabilized, you might think the worst is over, but I need you to mentally rewind. Go back to last Friday afternoon, 3 p.m. Eastern. Do you remember the feeling? In a span of 48 hours, gold plummeted 20%. Silver saw months of gains erased in a single vertical red line. The financial media called it a correction. They called it profit-taking. They are lying to you. What you witnessed last Friday was not a market correction. It was a liquidity flush, a calculated mechanical execution designed to strip assets from weak hands before a major policy shift. I need you to stop celebrating the recovery for a moment. Put down the coffee and look closely at the volume bars, not the price action. Because while you were staring at the crash in horror, a $10 billion signature was being drawn on a document in Washington. Before we open the file on the actual XM Bank press release, which I have right here, I have a question for the serious observers. When the algorithms triggered that sell-off last Friday, did you hold your position, or did the volatility force you out? Tell me in the comments. I want to see who's still standing. Let's surgically remove the noise and look at what actually happened. To understand why the price of silver is green today, you must first understand exactly how it was murdered last Friday. Most retail traders look at a chart and see a red candle. An institutional analyst looks at that same chart and sees a crime scene. The crash that occurred Friday afternoon was not driven by fundamental selling. No mine closed down. No industrial user stopped buying chips or solar panels. The demand for physical metal remained absolute. What you saw was a leverage flush executed with military precision. Here's the mechanics of the operation. The Chicago Mercantile Exchange, the entity that controls the paper derivatives market for precious metals, has a tool called the initial margin requirement. This is the amount of cash you must have in your account to hold a contract. When the price of silver began to rise too aggressively earlier in the week, threatening to break key resistance levels, the exchange raised these margin requirements. This is standard procedure, but the timing was impeccable. It happened on a Friday afternoon. Asian markets were closed. The London fix was done. Liquidity, which is the ability to absorb large sell orders without crashing the price, was at its thinnest point of the week. When the margin requirement goes up, the speculators, the people betting with borrowed money, receive a margin call. They have two choices: deposit more cash immediately or sell the position at market price to cover the debt. On a Friday afternoon, most hedge funds and algorithmic traders don't wire cash. They sell. This creates a feedback loop. The first wave of selling drives the price down. This price drop triggers the stop-loss orders of the next tier of traders. Their automatic selling drives the price down further, which triggers the next margin call. It's a cascade. It's a domino effect designed to wipe out the leverage. Frank Giustra, a man who spent 40 years in this industry, confirmed this was a technical takedown, not a fundamental shift. But here's where the story shifts from market mechanics to geopolitical strategy. While the paper hands were panic selling on Friday, the United States government was preparing to enter the room. On Monday, the media headlines screamed about a $12 billion stimulus, but I pulled the actual press release from the Export-Import Bank Board of Directors dated February 2nd. Look closely at the fine print. It's not a $12 billion check. It's a direct loan of up to $10 billion. Why does this distinction matter? Why am I forcing you to look at the difference between $10 billion and $12 billion? Because the remaining $2 billion isn't coming from taxes. It isn't coming from the printing press. It's coming from private sector partners listed in paragraph 3 of the document. The document explicitly names Hartree Partners, Mercury Americas, and Trafigura. If you don't know these names, you should. These are not banks. These are not tech companies. These are the shadowy giants of physical trading. These are the companies that move the actual molecules of the global economy. They move the oil, the copper, the cobalt, and the silver. By giving them $10 billion in cheap government financing, the United States hasn't just entered the market. They've handed a loaded gun to the most aggressive traders in the world and said, "Go clear out the inventory." This is a critical distinction. If the government set up a bureaucrat in Washington to buy silver, the market would laugh. Bureaucrats are slow. Bureaucrats are price insensitive. But Trafigura, Mercuria, these are wolves. They know every refinery schedule. They know every shipping route. They know exactly where the weak hands are holding physical inventory. The structure of this deal is a public-private partnership. In plain English, that means the government takes the risk and the private traders execute the strategy. The government provides the $10 billion balance sheet, and the traders provide the execution. Think about the incentives here. These trading firms are putting up $2 billion of their own equity to unlock $10 billion of government leverage. That's a 5-to-1 leverage ratio guaranteed by the state. Do you think they're going to buy at the top? No. They need the price lower to enter. This explains the Friday crash. The leverage flush on COMEX lowered the paper price, creating a disconnect from reality. This allowed the partners of Project Vault, Trafigura, Mercuria, Hartree to step into the physical market and secure long-term contracts at a discount. While you were selling your silver ETF because the chart looked scary, the entities backed by the United States government were securing the physical supply chain for the next decade. And look at who they're buying for. The document lists the beneficiaries. These are the original equipment manufacturers. The press release names Boeing, Western Digital, and GE Vernova. This tells you exactly where the silver is going. It's not going to jewelry stores. It's going to aerospace. It's going to data storage. It's going to the energy grid. Boeing cannot build guidance systems without silver. Western Digital cannot build the hard drives that power the AI revolution without silver. GE Vernova cannot build the wind turbines and grid infrastructure without silver. These companies are now effectively state-sponsored hoarders. The just-in-time inventory model, where companies held zero stock to save money, is dead. It's been replaced by the just-in-case model, funded by the Export-Import Bank. This is the dawn of state capitalism in the West. We're no longer talking about private companies competing for resources in a free market. We're talking about the United States Treasury effectively printing money to arm private traders to corner the market for national security purposes. When the government becomes the whale, price sensitivity disappears. A private corporation has a budget. If silver goes to $100, they might go bankrupt. The United States government can simply print more currency to pay the interest on the $10 billion loan. They are the buyer that cannot go broke. So the next time you see a flash crash on a Friday afternoon, ask yourself, who benefits? Who has the liquidity to step in when everyone else is stepping out? The answer is on the document I just showed you. The answer is Project Vault. To understand the gravity of the Project Vault document, we must step away from the present and look at history. We need to ask why the United States is suddenly partnering with private commodity traders like Trafigura and Mercuria to stockpile metal. Why now? The answer lies in a vault that has arguably remained sealed for over 70 years. Frank Giustra brought up a point that should send a shiver down the spine of every sovereign bondholder. The last time there was a full verified physical audit of the United States gold reserves at Fort Knox was 1953. Dwight D. Eisenhower was president. Television was a novelty. The internet was science fiction. Think about the absurdity of that statement. The entire global financial architecture, the valuation of the $38 trillion debt pile, rests on a pile of yellow metal that has not been properly counted, assayed, or verified in nearly 3/4 of a century. The government treats the audit of its own collateral as a matter of state secrecy rather than public trust. As Giustra noted, maybe it's pledged, maybe it's leased, maybe it's just not there. But while the mystery of the gold is terrifying, the reality of the silver situation is catastrophic. And this is where the narrative pivots from speculation to documented fact. We don't need to guess if the United States has a strategic stockpile of silver. We know the answer. The answer is zero. Throughout the mid-20th century, the United States held the largest stockpile of silver in human history. It was a strategic asset held for industrial application and monetary stability. But starting in the 1980s and accelerating through the 1990s and early 2000s, Washington made a fatal calculation. They believed the era of hard assets was over. They believed in the end of history. They believed that financial derivatives could replace physical commodities. So they sold it. They sold it all. They dumped billions of ounces onto the open market to suppress the price, to make the dollar look strong, and to cover short-term budget deficits. It was the geopolitical equivalent of a homeowner selling the copper wiring out of their own walls to pay the electric bill. This brings us to the irony of this week. The Exim Bank document, that $10 billion loan approval, is the United States government waking up with a hangover, realizing they've hollowed out their own industrial base. They're now trying to spend $10 billion to buy back what they sold for pennies. But there's a problem. The silver is gone, and the entities that bought it are not friendly allies. This is where we must look east. While the West was financializing its economy, turning everything into a paper contract, the East was industrializing. While the United States was selling its stockpile, China was building its own. Frank Giustra highlighted a discrepancy that's statistically impossible. The The official Chinese gold reserves are listed at around 2,300 tons. This is a joke. It's a fabricated number designed to keep the West calm. If you track the physical flow of metal, the bars leaving Swiss refineries, the deliveries into the Shanghai Gold Exchange, the real number is likely 10 times that amount. But the real story today is not gold. It's the export license. Just as the Exim board approved this $10 billion loan for Project Vault, Beijing tightened the noose. China is playing its cards with export restrictions on silver. This is not a trade tariff, this is a denial of service attack on the Western supply chain. China dominates the processing of these metals. They control the refining capacity. By requiring a license to export, they've effectively placed a valve on the global supply. They can turn the flow on or off at will, connect the dots. On one side of the Pacific, you have the United States authorizing Trafigura and Mercuria to use $10 billion of government credit to secure inventory. On the other side of the Pacific, you have China holding the physical keys to the warehouse, saying, "We are no longer interested in your paper. This is the silent war we've been warning you about. It's not fought with tanks, it's fought with supply chains." The reason silver prices are reacting so violently, crashing on paper leverage last Friday, then exploding on physical demand today, is because we're witnessing the collision of these two tectonic plates. The paper market on COMEX is trying to price an asset that the physical market in Shanghai is hoarding. The arrogance of the lease is ending. For decades, the West leased the manufacturing capacity of the East, paying them in dollars. Now the landlord is changing the locks. The United States has realized too late that you cannot build an F-35 fighter jet with a Bitcoin, and you cannot build a Tomahawk missile with a treasury bond. You need physical silver. Project Vault is not a stimulus plan. It's a panic button. It's the United States government admitting that they're naked in a blizzard. And when a superpower panics, the price of the life raft, in this case silver, doesn't just go up. It decouples from reality. We're moving from a price discovery model based on speculation to a price discovery model based on desperation. The empty vault in America is staring across the ocean at the full vault in China, and the only bridge between them is a rapidly devaluing dollar. Let's strip away the politics and look at the physics. To understand why the United States government is panicked enough to approve a $10 billion direct loan in a single afternoon, you have to understand what silver actually is. To the average person, silver is jewelry. It's a second-place metal. It's the poor man's gold. To a military engineer or a tech manufacturer, silver is the single most indispensable metal on the periodic table. It's the most reflective element, it's the most thermally conductive element, and most importantly, it's the most electrically conductive metal known to man. You cannot cheat physics. You cannot build a high-tech society with copper alone. This is the invisible war of industrial demand. And this is why the Export-Import Bank document explicitly names Boeing, Western Digital, and GE Vernova. These are not random names pulled from a hat. These are the arteries of American power. Let's break down why these three companies are on the list and why they're terrified of a shortage. First, look at Boeing. The document lists them as a key beneficiary. Boeing doesn't care about the spot price on COMEX. They care about the guidance system in a Tomahawk cruise missile. They care about the avionics in an F-35 fighter jet. They care about the silver-zinc batteries that power their torpedoes. Every single one of these weapon systems requires physical silver to function. You cannot build a smart bomb with a paper derivative. You need the metal. Second, look at Western Digital. This is the data storage giant. We talk about the artificial intelligence boom. We talk about NVIDIA chips. But what we don't talk about is the physical infrastructure required to connect them. High-speed servers, solid-state drives, and the massive data centers being built in Texas all rely on silver contacts. Why? Because at those processing speeds, any electrical resistance produces heat, and heat kills efficiency. Silver is the only metal that can handle the load. Western Digital knows that without silver, the AI revolution hits a physical wall. Third, look at GE Vernova. This is the energy grid. The green transition is a metal-intensive transition. A standard solar panel uses roughly 20 grams of silver. The new generation of high-efficiency panels uses even more. The world is installing these panels at a rate that's vertical. GE Vernova is tasked with rebuilding the American grid, and they cannot do it if the silver supply is locked up in Shanghai. Now look at the supply ledger. This is where the forensic data becomes alarming. According to independent auditing firms, the silver market has been in a structural deficit for 5 consecutive years. We're consuming more metal than we're pulling out of the ground. In 2025 alone, the deficit was hundreds of millions of ounces. Where did the extra silver come from? It came from above-ground stockpiles. It came from the warehouses in London and New York. But those stockpiles are not infinite. If you look at the data from COMEX, specifically the registered category, which is the silver that's fully warranted and available for immediate delivery, it's been bleeding out. It's down nearly 70% from its highs a few years ago. We're scraping the bottom of the barrel. This brings us back to the events of last Friday and the recovery we're seeing today. When the price crashed on Friday due to the margin hike, the paper speculators ran for the exits. But the procurement officers at Boeing, Western Digital, and GE Vernova, they saw the price drop as a gift. Industrial demand is price inelastic. If you're building a billion-dollar data center or a fleet of fighter jets, you don't cancel the project because silver went from $30 to $40. You pay the price. You have to pay the price. In fact, when you see volatility like we saw on Friday, your instinct is not to sell. It's to hoard. You panic buy because you're terrified that next week there might not be any metal left to buy. This explains the V-shaped recovery on the charts. The price dipped, and the physical vacuum sucked up every available ounce. The Export-Import Bank knows this. That $10 billion loan is designed to give these companies the firepower to secure inventory before it disappears. They know that China controls the refining capacity. They know that the mines in Mexico and Peru are struggling with grades and political instability. They know that we're approaching a mathematical limit where the paper price, the price you see on your screen, becomes irrelevant because there's no physical metal available at that price. We call this unobtainium. It's the moment when the price of silver decouples from the dollar and becomes purely a function of availability. If you have it, you name the price. If you don't have it, your factory stops running. The 11% bounce you're seeing today is the market realizing that the paper flush on Friday didn't create a single ounce of new silver. It just made the remaining ounces cheaper for the state-sponsored whales to swallow. The deficit is still there. The demand is accelerating, and the vaults are getting emptier by the day. So where do we go from here? We have the document, we have the names, Hartree, Mercuria, Trafigura, Boeing, Western Digital, and we have the number, $10 billion of direct government financing. Now we must talk about survival. I'm not here to give you financial advice. I'm a data analyst who reads the footnotes, and the data from this press release is screaming a very specific warning. Don't bet against this capital stack. If you're shorting this market because the chart looks overextended, you're standing in front of a freight train. You're betting against the combined purchasing power of the U.S. aerospace, energy, and tech sectors leveraged by the U.S. government. That's a suicide mission. But if you're long with massive leverage, you're just as vulnerable. As we saw on Friday, the big players, the traders like Trafigura and Mercuria, know how to play this game. They will shake the tree. They will hunt your stop loss. They will use the paper market to crush you before they take the physical metal. The strategy for the rational observer is to align yourself with physical reality. The United States is moving from a just-in-time economy to a just-in-case economy. Project Vault is the proof. You must delever. Remove the counterparty risk. Own what you can hold. Do your own due diligence. Understand the risks. The United States just admitted they sold their entire strategic silver stockpile decades ago. Fort Knox hasn't been audited since 1953. China controls the refining. The deficit is 5 years running, and the government just authorized $10 billion to buy back what they sold for pennies. The Friday crash wasn't a correction. It was a hunting expedition, and the state-sponsored whales got everything they wanted. The document is signed. The capital is deployed. Boeing, Western Digital, and GE Vernova are armed with government-backed purchasing power. And China just tightened export restrictions. The paper price says recovery. The vault data says we're running out. And here's the question keeping Pentagon procurement officers awake at night. What happens when Trafigura and Mercuria finish securing their positions and there's nothing left for anyone else? What happens when the next company that needs silver finds out the warehouse is empty and China wants payment in something other than dollars? That answer is coming. And when it does, the price won't recover. It will detonate. Choose your moment. This is your host, OG John, signing off.